If you have the Non Habitual Residence scheme in Portugal and you're looking to remain in Portugal after the end of that 10-year period, then there's certain things that you need to be aware of, certain planning opportunities that exist now while you're still in your NHR period, and that's going to be the focus of today's video. Hi, my name is Mark Quinn. I'm a Chartered Financial Planner and UK Qualified Tax Advisor, and I help clients that are either living in or relocating to Portugal, and I assist them with their tax and financial planning affairs. And I've done a number of videos about tax and financial life in Portugal, about relocating here, but just looking through my videos, I realised that I've spoken a lot about the NHR scheme, the benefits of the scheme, and the importance of getting into the scheme when it was available, but I've not actually covered what you need to be doing to plan for the end of your NHR scheme, because the NHR is a definitive 10-year period. After that, the goalposts change as regards your tax position. So just firstly, to recap the key benefits of NHR, the first is general tax-free income and gains on foreign interest and dividends. So a lot of you taking income from UK portfolios, rental property, and currently that's all tax-free here in Portugal. If you got into the NHR scheme prior to April 2020, then also pension income would be free of tax. For those of you qualifying after April 2020, then you have the 10% flat rate of tax on pension income. Still a really attractive rate to have. And again, that changes at the end of your NHR period. Also, gains on foreign property sales are also generally free of tax if you sell whilst you're NHR. So a lot of you with buy-to-let portfolios, second homes, or even main residence in the UK, former main residence in the UK, that's free of tax in Portugal. And again, the position changes after NHR. What isn't covered under NHR is income from blacklisted jurisdictions, and the most common ones we see for our clients are income from the Isle of Man, Guernsey or Channel Islands. So even if you have NHR status, interest from bank deposits in any of those jurisdictions would be taxable. Also, gains on shares and investment portfolios, whether you have NHR or not, they're going to be taxed here. The starting rate is 28%. But if you buy and sell within a 1-year period, it actually goes onto the income tax scales rather than capital gains, and therefore you pay tax at the progressive rate, so it can get quite high because the top rate is 48%. And the final type of income that's not covered is Portuguese source income, so interest, dividends from Portuguese companies or banks are taxable here at the flat 28% tax rate. So what happens if you don't do anything? What happens if you just switch from NHR to standard tax residency status at the end of 10 years? Well, any interest and dividends you're taking from UK companies or portfolios would switch from a 0% rate to a 28% tax rate. The interest or dividend payment is also taxed on a rising basis. So it doesn't matter whether you receive the income or not. The taxable event occurs when the income is paid, so whether it's paid directly to you in your bank account or whether it's paid in inverted commas but kept within the investment portfolio, the position's the same, the taxable event occurs at that point. Pension income will switch from either the 0% rate for those of you qualifying pre-April 2020 or the 10% rate for those of you after April 2020. And it will switch from that rate to as high as 48%. So it gets added to your scale income. This is where things get a bit complicated in pension land, because there's different ways of reporting pension income in Portugal. One of which is it gets added to your scale income, and the more you earn, the higher the tax rate goes. The other is it could be treated as investment income and taxed at the flat 28% rate. Or the other methodology that's commonly used here is what's called the 85-15 treatment. So when you're taking money from a pension scheme, 85% could be deemed a return of your capital and only 15% taxable. and the 15% that is taxable gets added to the scale rates of income. But again, it comes down to interpretation and how your local accountant will be reporting this to the tax authorities on your behalf. And the final issue is property sales. So as I mentioned before, if you're selling a UK property or property elsewhere, subject to the terms of the double taxation treaty between that country and Portugal, it's generally free of tax here. After an HR, then it's going to be taxable. Now, how it works in Portugal is that property gains are taxed and added to your income, but only 50% of the gain is added to your income. So if 50% of your gain is added to the income, generally that's going to push you up into the highest tax rates at 48%, and therefore the effective tax rate becomes 24-25% tax. So what can you do in advance of the end of your NHR period? Well, the first issue you can be thinking about is mitigating any further gains on directly held share portfolios and ISAs. So as I said before, it doesn't matter whether you have NHR or not, gains on shares, investment portfolios, ISAs, they're all taxed here as per normal capital gains tax rules. So the longer you have those in place, with markets generally moving up over time, the tax issues is going to get worse and worse. So you could look to so-called rip the plaster off in terms of putting a cap on the level of tax you pay and restructuring into something that works better from a Portuguese tax point of view going forward. The other obvious issue is to look at property sales. If you are planning to sell the property at some point, then it may make sense to do that whilst you've still got your NHR status because it's tax-free. This is quite important for those of you with former main homes in the UK. I've seen a couple of expensive mistakes recently with clients selling their former main home in the UK after their NHR has expired. Now, as a concept in the UK, we never pay tax on our main home and all periods in respect of which we occupied it as our main home wouldn't be taxed. But that's an alien concept for the Portuguese. They're always taxed on sales of property here. So if you sell your former main home in the UK after your NHR expires, even though you may not pay tax in the UK or the tax bill in the UK might be quite small, the tax bill here could be quite expensive. So just be cognizant of that sort of time limit. The other obvious point is with pension income at NHR tax at the preferential 0 or 10% rates, it may make sense to withdraw those schemes either in part or full prior to the end of NHR. Now the goalposts have shifted in this respect because there's a consultation underway to bring pensions within the scope of IHT from April 2027. So in the past we may have said leave money in the pension scheme because it's always going to be outside your estate for inheritance tax purposes. Now they're shifting those goalposts. Pensions are becoming less attractive from an inheritance tax and succession planning tool, and therefore it adds weight to the argument to extract it from the pension scheme if you can still qualify for the NHR rate and again restructure into something that's going to be tax efficient longer term. That brings me to the next issue. What can you look at as an appropriate longer term home for your savings and investments? If you are going to restructure share portfolios, ISAs, pensions, etc., then there's generally three options. The first one is investing directly, but that's not really going to do much for you tax-wise, which brings the main two options as being QNUPS, so qualifying non-UK pension schemes. Although they've lost a lot of their attractiveness in the sense that from April 2027 they're going to be brought in the scope of inheritance tax in the same way that a non-pension asset would be. So Portuguese compliant investment bonds, PCIBs, are quite popular structures, and because they have a tax step down of 5 and 8 years, if you put those in place early on in your NHR period, you're basically securing yourself a very low tax rate for when your NHR eventually expires at the 10-year point. So I hope that gives you some pointers and some things to be thinking about as you plan towards the end of your NHR scheme. And if I can be of any help, please let me know.